In the intricate world of finance, there exists a single pervasive force that quietly shapes our economic lives. It's a number often expressed as a simple percentage, yet it holds the power to build fortunes or dismantle dreams. It dictates the cost of our homes, the growth of our savings, and the very health of the global economy. This force is the interest rate. But for millions, its true nature remains a mystery, a piece of financial jargon that feels both distant and intimidating. We see it fluctuate in news reports, hear it mentioned by politicians, but few truly grasp the profound impact it has on their daily decisions. How can something so fundamental be so misunderstood? What are the hidden mechanics behind this number, and why is failing to understand it one of the costliest financial mistakes a person can make? The story of interest rates isn't just about economics. It's a story about power, opportunity, and financial survival. To unravel this, we must go back and understand not just what an interest rate is, but why it matters more than you could ever imagine. Imagine two friends, Sarah and Mark, both in their late 20s, with similar jobs and identical salaries. They each have a dream, to buy their first home. They both save diligently, and after a few years, have enough for a down payment on a $400,000 house. On the surface, their paths seem parallel, their futures equally bright. But here, their stories diverge, dictated by a single, crucial difference: their understanding of interest rates. Sarah, a meticulous planner, had spent months researching the financial landscape. She understood that an interest rate wasn't just a fee. It was the price of borrowing money over time. She watched the market, read analyses from financial experts, and learned to recognize the signals of a changing rate environment. When she saw that central banks were signaling future rate hikes to combat rising inflation, she knew her window of opportunity to secure a low-cost loan was closing. She acted decisively, locking in a 30-year fixed-rate mortgage at 3.5%. Mark, on the other hand, viewed interest rates as an afterthought, a minor detail to be handled by the bank. He focused solely on the sticker price of the house and the excitement of becoming a homeowner. He casually heard news about rates going up but dismissed it as noise, something that didn't apply to him directly. He delayed his house hunt by another 8 months, prioritizing a vacation and a new car. When he finally found the perfect home, also priced at $400,000, the world had changed. The central bank had followed through on its warnings, and the average mortgage rate had climbed to 6.5%. That's a difference of $732 every single month. Over the course of a year, Mark would pay $8,784 more than Sarah for the exact same priced home. Over the full 30-year term of the loan, the difference is staggering. Mark would pay over $263,000 more in interest than Sarah. This wasn't a stroke of bad luck. It was the direct result of a knowledge gap. Sarah's understanding allowed her to leverage time and information to her advantage, securing financial stability. Mark's ignorance trapped him in a cycle of higher costs, eroding his disposable income and limiting his ability to save, invest, or handle unexpected emergencies. The same dream, the same house, but two vastly different financial realities, all hinging on the comprehension of a single percentage. This isn't just a story about a mortgage. It's a microcosm of how interest rates quietly carve out our financial destinies every single day. Understanding interest rates is not merely an academic exercise. It is the cornerstone of financial literacy and the key to navigating the modern economic world. At its core, an interest rate is the price of money. When you borrow money, the interest rate is the fee you pay to the lender for the privilege of using their capital. It's their compensation for the risk they're retaking and for the opportunity cost of not using that money elsewhere. Conversely, when you save or invest money, for instance, in a high-yield savings account or a corporate bond, the interest rate represents your earnings. It's the reward you receive for lending your capital to a bank or a company, allowing them to use it to generate their own profits. This dual natura costs when you borrow. A reward when you lend is fundamental. Grasping this concept transforms your relationship with money from passive to active. It empowers you to see that your decisions are not made in a vacuum. They are part of a dynamic system of borrowing and lending that underpins our entire economy. Armed with this understanding, you begin to make fundamentally smarter decisions. Consider the act of taking on debt. For most people, borrowing is a necessity for major life purchases like a car, a home, or an education. A person who doesn't understand interest rates focuses only on the monthly payment. Can I afford this payment right now? They ask. But the financially literate person asks a more sophisticated set of questions. What is the total cost of this loan over its entire lifetime? What is the annual percentage rate, APR, which includes fees and gives a truer picture of the cost? Is this a fixed rate that will stay the same, or a variable rate that could skyrocket in the future, leaving me vulnerable? This deeper level of inquiry protects you from predatory lending practices and prevents you from falling into debt traps where high compounding interest makes it nearly impossible to pay off the principal. You learn to differentiate between good debt, like a low-rate mortgage on an appreciating asset, and bad debt, like high-interest credit card balances used for depreciating consumer goods. On the other side of the coin is investing. Understanding interest rates unlocks a world of opportunities for wealth creation. You realize that simply letting your money sit in a zero-interest checking account is actually a losing proposition. Due to inflation, the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling, that idle cash is losing value every single day. A solid grasp of interest rates pushes you to seek out investment vehicles that can outpace inflation. You start exploring options like certificates of deposit, CDs, government and corporate bonds, and dividend-paying stocks. You learn about the principle of compound interest, which Albert Einstein reportedly called the eighth wonder of the world. It's the process where you earn interest not only on your initial principal, but also on the accumulated interest from previous periods. It creates a snowball effect that can turn modest savings into a substantial nest egg over time. But it only works if you are proactive in putting your money to work in interest-bearing accounts and investments. Without understanding interest rates, you are essentially flying blind. Unable to distinguish between financial instruments that build wealth and those that let it wither away, you are leaving your financial future to chance, vulnerable to the silent erosion of inflation and the missed opportunity for growth. The story of interest rates is, in essence, the story of financial empowerment. In a world of economic uncertainty, where headlines about rate hikes and market volatility can induce anxiety, knowledge is your shield and your sword. It protects you from the pitfalls of crippling debt and arms you with the tools to build a secure and prosperous future. To ignore the language of interest is to willingly surrender control over your financial destiny, allowing hidden costs to drain your resources and unseen opportunities to pass you by. The choice to understand this fundamental concept is not just a smart financial move. It is one of the most important decisions you will ever make for your long-term well-being. The numbers on the screen are more than just data. They are the levers that can move your world. The only question is whether you will be the one in control.